Most people do not notice the trap when it begins. They notice it later, after the monthly payments have already become part of everyday life. The bill arrives, the payment gets made, life moves forward. From the outside, nothing appears broken. The household still has income, the mortgage may still be getting paid. The family may still consider itself firmly middle class. And yet, month after month, something important is changing. Retirement flexibility is quietly disappearing. The problem is not always obvious at first. In fact, many families never see it as a credit card problem at all. They see it as a temporary solution to a temporary challenge. Maybe it starts with a car repair, a medical bill, a home repair, an insurance increase, groceries that cost more than they used to, help for an adult child who needs support. One charge becomes another, then another. Each decision feels reasonable on its own. For many households, that is exactly how the story begins. The card is not being used for luxury, it is being used to smooth out cash flow. The balance is supposed to be temporary. The trouble is that temporary balances often stay longer than expected. And, at age 50, that matters more than many people realize. This is where the fault line begins. At younger ages, a financial setback may still leave decades to recover. There is often more time to rebuild savings, increase earnings, or recover from a mistake. After 50, the timeline starts to change. Retirement contributions often need to accelerate. Healthcare costs become more likely. Future earning power may become less predictable. Job disruptions can be harder to recover from. The same balance that seemed manageable at 35 can become much more significant at 58, not because the debt changed, because the clock changed. What makes this especially difficult is that the situation can still feel under control. Many households continue making every required payment. The account stays current. There are no collection calls. No dramatic financial crisis. The minimum payment creates a sense of progress, but that feeling can be misleading. Many people assume the danger begins when a payment is missed. In reality, one of the biggest risks is making every payment while the balance barely moves. The household feels relief each month because another payment was made. Meanwhile, the underlying problem remains. What looks manageable on paper can become much more difficult in real life. The numbers help explain why. According to the New York Federal Reserve, total U.S. household debt reached $18.8 trillion in the first quarter of 2026. At the same time, credit card borrowing remains one of the most expensive forms of household debt. Federal Reserve data showed that average credit card interest rates on accounts assessed interest reached 21.52% in February 2026. Across all credit card accounts, average rates were approximately 21%. This is not low-cost borrowing, it is high-cost borrowing, and the consequences are visible at a national level. According to Consumer Financial Protection Bureau data, consumers paid more than $160 billion in credit card interest during 2024. Just 2 years earlier, that figure was about $105 billion. That increase helps illustrate the scale of money flowing out of household budgets and into interest payments. The problem is not confined to a small group of people. Credit card debt is remarkably common. Data from the Survey of Consumer Finances showed that 46% of U.S. households carried credit card debt in 2022. Research also indicates that households carrying balances tend to be heavily represented within the middle-income population. In other words, this is not simply a story about financial irresponsibility. It is a story about ordinary households facing financial pressure, and that pressure has been building. Recent inflation data showed continued increases in several essential categories. Shelter costs rose 3.3% year-over-year. Hospital services increased 5.5%. Motor vehicle maintenance increased 5.1%. These are not luxury expenses. They are part of everyday life. When essential costs rise, families often look for ways to preserve stability. A credit card can appear to provide that stability. It bridges the gap between expenses and available cash. For a while, the strategy may seem successful. The lights stay on, the repair gets completed, the insurance bill gets paid, life continues. But every bridge becomes more dangerous when there is no clear exit on the other side. Over time, the balance begins competing with other priorities. Emergency savings may stop growing, retirement contributions may slow, plans to pay down other obligations may get postponed. Cash reserves become thinner. This is why the real risk is not one bill. It is the gradual loss of financial flexibility. And that loss becomes especially important later in life. Research from EBRI found that debt remains widespread among older households. In 2022, 77.2% of families headed by individuals ages 55 to 64 held debt. Among families headed by those ages 65 to 74, the figure was 64.8%. Those numbers are a reminder that debt does not automatically disappear as retirement approaches. In many cases, retirement arrives while debt is still present. For near retirees, that creates a difficult challenge. Every dollar directed toward high-interest debt is a dollar unavailable for other goals. Every month spent carrying expensive balances can reduce future options. This does not mean retirement becomes impossible. It means the margin for error becomes smaller, and that distinction matters. One of the most common misunderstandings is the belief that a manageable payment means a manageable situation. Many households tell themselves that as long as the minimum payment is affordable, everything is fine. The problem is that affordability and progress are not always the same thing. Another misunderstanding is that credit card debt is primarily a young person's issue. The data tells a different story. Debt remains common well into the years when retirement preparation becomes most important. There is also a tendency to believe that necessary expenses somehow create less dangerous debt. Emotionally, that idea makes sense. A medical bill feels different from a vacation purchase. A car repair feels different from entertainment spending. But the interest rate does not care why the original charge was made. The balance grows under the same rules regardless of the reason it appeared. That is why even responsible decisions can create difficult outcomes. The strongest lesson in this story is not about blame, it is about timing. The credit card trap after 50 is rarely caused by one reckless decision. More often, it develops through dozens of reasonable decisions made under pressure. A household protects its lifestyle, it handles emergencies. It absorbs rising costs, it stays afloat. Then, little by little, retirement flexibility begins to shrink. The practical shift is to stop viewing credit card debt only as a monthly payment. Instead, view it as a claim on future financial options. Ask a different question, not simply, can we make this payment, but, what opportunities is this payment replacing? Could it have strengthened emergency reserves? Could it have supported retirement preparation? Could it have increased financial flexibility later in life? These questions do not require panic, they require attention. Because the problem is not always obvious at first. The fault line develops quietly, the household still looks stable. The bills still get paid, life continues as usual. But beneath the surface, a growing share of future flexibility is being exchanged for present stability. That trade-off becomes more expensive with age. And that is why the credit card trap after 50 deserves attention. Not because every balance leads to disaster. Not because retirement becomes impossible. But because what appears manageable today can gradually limit choices tomorrow. For many middle-class families, the greatest danger is not a financial emergency that arrives overnight. It is the slow loss of options that happens month after month while everything appears normal. This does not mean panic. It means paying attention earlier, because the real risk is not one bill. It is the quiet disappearance of financial flexibility when there is less time left to replace it. And that is the fault line many households do not see until it has already widened beneath them.